In the credit scoring world, age and experience count 15% towards your credit score. It's called length of credit history. Your credit report has an age just like anything else, and that age has a positive or negative value to your credit score. This value equates to 15% of the points that make up your overall credit score. Each of the accounts on your credit report has a field called Date Open. This date has been reported to the credit reporting agencies by your creditors. The date open is the month and year that the account was open. The credit scoring model can read this date and age the account by calculating the number of months and years that the account has been open. Once this is done on all of the accounts, the model will then determine which one is the oldest. Another important measurement is the average age of your accounts. This is simply the average age of all your accounts as measured using, again, the date open fields. For example, if you have two accounts that are 3 years old and 5 years old respectively, your average age of credit will be 4 years. To earn a credit score, borrowers need to have at least some credit history. Although it's not the most heavily weighted factor used to calculate a borrower's credit score, the length of a borrower's credit history does matter. Generally, the older your length of credit history, the better it is for your score. Even if your credit history isn't perfect, it's still important to have one. It's better to have some sort of credit history, even if there have been some problems, rather than no credit history at all. That's because without a credit history, banks don't know what kind of borrower you'll be in the future. This should be taken into consideration when removing negative items from your credit report. How much history is enough history? The minimum amount of credit history needed to generate a credit score is 6 months or more on at least one credit account. There also has to be at least one undisputed account reported to the credit reporting agency within the past 6 months to generate a credit score. These scoring requirements can be met by a single account or multiple accounts. That means a consumer who opened their first credit card 3 months ago and had no other loans would not yet have a credit score, regardless of how responsible they were with that card. Although accounts don't need to be open, they do need to still appear on your credit report to be counted by the credit scoring. So even if an account was closed 5 years ago, its continued appearance on a credit report would help extend a borrower's length of credit. Closed accounts won't appear indefinitely. However, closed accounts that were always paid on time remain on credit reports for 10 years from the date of closure or last account update, while accounts with late payments remain for 7 years from the date of the first delinquency. How do you build credit with no credit? For consumers with no record of credit accounts, there's a catch-22. They don't have a credit score because they don't have a credit history, and they may have trouble building a credit history without a credit score. Consumers who recently experienced bankruptcy or other damaging events could likewise find their lower credit scores make it difficult to open new accounts in order to rebuild their credit history. So what should they do? Department store cards. If you are an individual who is looking to actually start establishing credit for the first time, signing up for a department store card such as Macy's, Sears, Nordstrom's, etc. can be an easy approval and a great way to actually establish credit for the first time. Please note, this is not an option for every consumer. If you already have bad credit established, you will not be able to use this method. Typically, interest rates are a bit higher with these credit lines, but if you keep your purchases small and pay off your entire balance each month, you may be surprised at the good credit you can build and actually benefit from. Secured credit cards. We recommend starting out with a secured credit card, which requires a deposit as collateral to secure the card's line of credit. Secured cards, because they require you to deposit money, are easier to obtain than a regular unsecured credit card. Consumers need to check that the secured card's issuer reports account activity to the 3 major credit bureaus. Then, the borrower should use that secured card for small purchases and pay off the entire balance each month. The credit bureau doesn't care how much you're paying. They just want to see those on-time payments and that your history is being built again. Some secured cards enable the borrower to upgrade to a standard unsecured account after a set length of time of responsible borrowing. So compare features on your secured card to see if that is a possibility. When shopping for a secured credit card, there may be a number of reasons you want to apply for the card without adding a credit inquiry to your credit report. Credit inquiries not only show where you have applied for credit, but depending on the individual credit report, can decrease your score by at least 5 points. From a lender's viewpoint, multiple inquiries within a short period of time can also indicate a credit risk. If you are worried about getting rejected for credit cards, resulting in multiple hard inquiries on your credit and a lower score than you started with, check out the secure cards in the download area below that don't require a credit check for approval. Secured installment loan. Many banks offer the option to apply for a secured installment loan, often referred to as a savings secure loan. The loan is backed by money held in a savings account. The money in the savings account is frozen until the loan is paid back, leaving no risk for the bank. As the loan is slowly paid up, the money is slowly unfrozen and can be used. When applying for a savings secure loan, some banks or credit unions won't do any hard pull since the money is 100% guaranteed by the savings account. Also, it's easy to get approved for such a loan since there's no risk to the bank. The main reason this type of loan exists is to help people rebuild credit. The trick is to find a bank who doesn't do a hard pull when opening an account and taking out a secured loan. Many local and regional banks and credit unions offer secured loans as a way to rebuild credit. You would simply head down to your local bank or credit union and speak with the loan officer. Let them know you wish to deposit $500 to $1,000 in a savings account or certificate of deposit and use that as collateral to borrow money from. Let the loan officer know that you're doing this to build or rebuild your credit profile. Once you have deposited $500 into a savings account or CD, and the lending institution has lended you $500, I recommend that you deposit that $500 into the savings account and set up an automatic draft payment that pays your $500 installment loan over the next 6 to 8 months. Credit builder loans. Credit builder loans are a different type of installment loan. Unlike the secured installment loan where you need the initial money to deposit into a savings or CD that you can use as collateral, a credit builder loan deposits the money you borrow into a savings account, one that you cannot access until you have fully repaid the loan. If you pay the loan as agreed, the financial institution promises to send a good report to the credit bureaus. A study showed an average improvement of 35 points with 6 months of on-time payments for loans as small as $100. At the end of the loan term, you get the money and likely a better credit score. But be sure to pay on time. If you miss payments, that negative information will also be reported. The financial institution doesn't take a big risk when it lends to you because it can reclaim the money if you don't hold up to your end of the bargain. If you're looking for a credit builder loan and your credit union or community bank doesn't offer them, you might try a few credit builder programs that we have listed in the download section below. Authorized user accounts. Another quick and easy way to add credit history is by using an authorized user account. If you have a friend or family member who you know has good credit, try asking that person to add you as an authorized user on their credit card account. This is a safe way of adopting their credit history onto your credit profile as long as they make their payments on time and keep their balances low. Being added as an authorized user does not allow you access to any of their information and does not give you the opportunity to spend on their credit line, but instead allows you to adopt their entire credit history from the account they added you to and can help with a healthy boost of points. Remember, always choose an individual who pays their credit card every month on time and keeps their credit card debt to the very minimum. Any credit line that is over 20% in debt will not increase your score's points. Purchasing trade lines. If you're unable to find a family member or friend who will add you as an authorized user to their credit card, you can always purchase a trade line. Trade line purchases are made possible when a company has aged trade lines that they would be willing to add you on as an authorized user for a fee. We do not recommend purchasing trade lines for three main reasons. 1. Trade lines can be very expensive. The average rate for purchasing an aged trade line is between $1,000 and $3,000. This amount is way over the cost of what it's worth. 2. Trade lines have expiration dates. Unlike your family member adding you as an authorized user forever, purchased trade lines usually only stay on a person's credit report 60 to 90 days, just enough time so that the person can qualify for a loan that they're applying for. 3. Temporary or not effective at all, because the authorized user does not stay for more than 60 to 90 days. Your score will temporarily be changed, but will not continue to count once it has been removed. Purchasing trade lines seems to be a last-minute, desperate resort for someone who is attempting to raise their score quickly for a short period of time in order to qualify for something based on their credit score. In the next module, we will discuss reestablishing new credit.